In this lesson, you're going to learn about all the different types of debt that we'll be using in the more advanced LBO model. Now, in the basic model, under debt assumptions, we said that there were two basic different types of debt, bank debt and high yield debt. Bank debt appeals to more conservative investors and carries with it lower interest rates as well as a principal repayment requirement each year. And then high yield debt, by contrast, is riskier and appeals to investors with more of an appetite for risk. It has a higher interest rate than bank debt, and there is no principal repayment. Instead, the entire balance of the debt is repaid at the end of the period, whether it's 5 years, 7 years, 10 years, something like that. Now, there are some other differences, but those are really the most important ones that we saw for the purposes of our basic LBO model. In the more advanced model, we're going to be expanding on those, and we'll be looking at three different types of bank debt: the revolver, term loan A, term loan B, and then two different types of high yield debt, subordinated note and a PIK loan, a paid in kind loan. I'm not going to go into all the details of these right now because I want to lay out some of our basic assumptions first. Once we have all this at the top decided, then we can get into some of the differences and how, even though these are all bank debt, the first three here, they are different, and how even though the last two here are high yield debt, they're also different and they're used for different purposes. So the first thing we need to decide here is the percentage for each of these different types of debt. So we have to say that a percent goes to each of the different tranches: term loan A, term loan B, subordinated note, and PIK loan. The revolver will come up, but we're going to calculate it a bit differently, and we're actually going to be using an absolute number for that one instead. So to begin calculating this, first I want to link in from the leverage ratio right above. Remember, we said that unlike the other model, with this one we're not using a percentage. We're assuming that Apple can instead raise 6x of its previous year's EBITDA. For the debt required, we can also link up to the top. This units for LIBOR item, this is just purely administrative. I'm going to enter 10,000 here. This is for something that we'll need later on. It's very similar to the units category that we had at the top of our three-step model right here for share units. Except this one for LIBOR is for interest rates rather than shares. So then for these percentages here for term loan A, B, subordinated note, and PIK loan, so what we have to do here is decide of the 79 billion worth of debt, how much is going to each different type of debt. Now at a bank, the way you would do this is once again look at debt comparables, recent debt issuances from companies, and figure out what allocations they have been making, what leverage ratios they have been using for each tranche of debt. So maybe companies in this industry on average have a 2x leverage ratio for term loan A and then a 1x leverage ratio for term loan B. If that were the case, then we might use that to make our calculations here. In general, companies like to allocate as much as they can to term loan A and then term loan B because term loan A generally carries with it lower interest rates. Term loan B is similar, but the interest rates are higher, there's less principal repayment, and you are moving closer to high yield debt the further down you go in terms of term loans here. Subordinated notes and PIK loans both have significantly higher interest rates, as well as more restrictive terms sometimes. So generally the way it works with debt is that companies allocate all they can to term loan A and B, and then whatever's left over, whatever else they cannot finance, they put toward subordinated notes and PIK loans. Now I said just now the words cannot finance, can't finance. What do I mean by that? Well, if we were to say that all of the term loan here, so 100% of term loan A, took up the entire debt required balance, so term loan A here was 79 billion, that's fine, except we may not be able to find investors who actually want to buy that much. Oftentimes investors will only buy up to a certain amount or a certain amount based on the leverage ratio of the loan. So in this case, if we were to say 100% of the debt required is taken up by term loan A, then we may have trouble actually getting investors for this leverage buyout to take place. So instead, we're going to allocate the majority of the debt to these two, term loan A and B, but then subordinated note and PIK loan, these will both have a smaller amount, but it has to be there because we're assuming that this entire 79 billion worth of debt cannot be financed solely with term loan A and term loan B. So for term loan A, I'm going to say 40%, term loan B, I'm going to say 30%, and then 20% for the subordinated note, and 10% for the PIK loan. Just to check our math, let me sum that up. And we see that it comes out to 100%. So to calculate the percentages here, you would think that we can just multiply these percentages times the debt required, but actually it gets a bit more complicated than that, and we have to do something a little bit different here. So what we're going to do instead is assume that this tranche of debt, the revolver, we're going to assume that this is an absolute number rather than a percentage. So very similar actually to what we did below under our operating assumptions with our minimum cash balance, we're going to be taking a similar approach, and I'm going to say $2 billion for the revolver here. Now, what does the revolver do? How is it different from these other types of debt? Why am I listing it separately here? The revolver is sort of like a credit card for a company. So if you take out a loan to go to college or to buy a car or to buy a house, well, that's more like term loan A, term loan B, and even some of the more risky types of debt, because you're going to have it over an extended time period, you have interest on it, you pay it off over time. A revolver, by contrast, is more for short-term purchases, short-term shortfalls in cash. So maybe the company needs to pay off a certain amount of debt, or they need to invest a certain amount in capital expenditures, but they don't have the cash. Well, if that's the case, then they would take out a revolver, and they would draw on the revolver to actually make sure that they have enough money to do the deal or to pay off debt or whatever the case may be. So a revolver is sort of like a credit card for a company. And you'll see this when we go into the debt schedules, but the way it works is that with the revolver, you start out undrawn. So to continue with the credit card analogy, when you have an undrawn revolver, that's sort of like when you have a $0 balance on your credit card. And then also, similar to a credit card, you only pay interest on this, on the revolver, if you actually accrue a balance to it. So you're only paying interest on this if you actually have a balance on your revolver. But in almost all cases in LBO, this starts off undrawn, and you only draw on it. You only actually take out debt. You only put debt on your corporate credit card, so to speak, with a revolver if you actually need it. So we're going to list this $2 billion here for right now, but keep in mind that unlike the other forms of debt, this one is not going to be drawn immediately. We're not going to immediately have debt on our balance sheet just because we have this item listed. This is just showing us the maximum amount, our so-called credit line with this revolver, the maximum amount that we can borrow short term to cover any shortfalls in cash. Now for the rest of these, I'm just going to take the percentages and multiply by debt required, anchoring that. We see we now have everything here. Now remember, the reason I'm not subtracting the revolver here is because this is not drawn. This is just the maximum amount that we can use for the revolver, but in the beginning of the transaction, we have no balance here. This is simply our maximum credit line. The others, by contrast, these are all going to be drawn at the time of the transaction, and these will immediately appear on the company's balance sheet. Now, for the interest rates here, I mentioned that in general, bank debt is going to have lower interest rates than high yield debt, and that's definitely true, so we'll be seeing that with our assumptions here, but there is one other important difference, which is that with bank debt, we have floating interest rates, and with high yield debt, we have fixed interest rates. What do I mean by floating versus fixed interest rates? Well, usually the way it works is that you tie floating rates to something called LIBOR. I have up here a Wikipedia definition. Its official name is the London Interbank Offered Rate. This is basically the short-term interest rate that banks in the UK, but also across the world, use for short-term borrowing. There's another definition here on Investopedia. So LIBOR changes on a daily basis, and this is the most common number that you tie floating interest rates to. So in our example here, we might say that the revolver is at LIBOR plus 250 basis points, or that term loan A is at LIBOR plus 350 basis points. The 250 and 350 basis points here simply mean 2.5% and 3.5%. So if LIBOR is currently 3%, then L plus 250 would simply mean 5.5%. L plus 350 would simply mean 6.5%. Now, as we move down from the revolver to term loan A to term loan B, the interest rates here generally go up. So for term loan B, I'm going to say LIBOR plus 500 basis points. So if LIBOR is 3%, then term loan B would be at 8% interest. Now, the important thing to note here is that LIBOR changes all the time. It's going to change from year to year, so these interest rates are also going to change. If the economy worsens and the government drops interest rates, these interest rates on debt will also drop. If the economy improves, there's inflation, and the government raises interest rates to combat that, then these interest rates will also rise. Now with these last two, high yield debt, so the subordinated note is just sort of a generic type of high yield debt. It's called subordinated because it has lower seniority than the other types of debt here. This is sort of just a generic type of debt. There's nothing too special about this one. This is sometimes referred to as a corporate bond. So for subordinated notes, I'm going to say 11% for the interest rate. And then for this last one, paid-in-kind loan. So this one's interesting because the way that interest works on a paid-in-kind loan is completely different from these others. With a revolver, with term loan A, term loan B, and subordinated note, you're always paying interest in cash. So it's coming directly out of your pre-tax income. You have an interest income or interest expense line item. But with a paid-in-kind loan, instead of the interest being paid in cash, the interest instead accrues to the principal of the loan. So let's say in this case you start off with 7.9 billion in your PIK loan. Well, if the first year you have 500 million in interest, instead of paying that 500 million in cash interest expense, it would simply get added to the principal of the loan, and you now have an 8.4 billion PIK loan. You have to repay the entire thing at the end, but generally that's how it works for paid-in-kind loans and how they're different from other types of debt. Now, as you might have guessed, these are significantly more risky than term loans A, B, for example, and even the subordinated note, because you're getting a ballooning balance here. You're getting a debt balance that could potentially go up to a very high level. So paid-in-kind loans are definitely the riskiest type of debt that we're looking at here. Since they're the riskiest, they also tend to carry the highest interest rates. So I'm going to say 13% here. Now, as always, to establish the exact interest rates, we would normally look at debt issuances, debt comparables, to see what similar types of loans recently have been issued at. For the principal repayment, the way this one works is pretty simple. For the revolver, we're just going to enter NA. The reason is because with a revolver, similar to a credit card, there isn't necessarily a requirement that you repay a certain amount each year. It depends on how much you've borrowed and how much you can repay. So with the revolver here, the way it's going to work is that any excess cash flow will immediately go toward paying off the revolver. If, on the other hand, we have no revolver balance or we have more than enough cash flow, then we can use that to pay off the rest of these. But there's no requirement with the revolver that you have to pay off a certain amount each year. With term loan A and B, by contrast, there is that requirement. So we're going to say 10% for term loan A and then 5% for term loan B. So we're saying here that 10% of the term loan A balance must be repaid each year, and 5% of the term loan B balance must be repaid each year. These are typical numbers. For term loan A, sometimes you see 20% or 25%. For term loan B, 5%, 10% are both common. Then for subordinated note and PIK loan, remember this is high yield debt, so there is no principal repayment. So we're going to say 0% for both of these. Now for the PIK loan, I mentioned before how interest accrues to the principal of the debt instead. So you might be wondering how that factors in here. The answer is it doesn't, because as with all other types of high yield debt, there's no requirement to actually repay that principal. The principal with PIK loans, unlike everything else, is actually growing over time, but there is still no requirement to actually repay part of that each year. Everything is still due at the end of the period. So that's how we set up our basic debt assumption schedule right here. Now I realize I went through this quickly, so if you want further information on this, you can look at the more advanced handout on different types of debt that is below this video. We don't go into all those different types of debt on the handout in this one. If you want to see 8 different tranches, 9 different tranches of debt, everything covered on that handout, you can look at the more advanced LBO model in the Yahoo case study. But for now, we're just going to keep this relatively simple and stick with 4 or 5 different tranches of debt. These are really the main ones that you're likely to see in interviews and in investment banking and private equity. So with these debt assumptions set, the next thing we need to do is, as with the basic LBO model, we're going to be looking at a sources and uses schedule. And we'll see how it's a bit different here because we have a lot more different types of debt and different types of fees, but in general, the concept is very similar. So that's what's coming up next. We'll be getting into our sources and uses schedule for this more advanced LBO model.